Hi, now in this video presentation I'm going to explain the what, the why, and the how of mutual funds and exchanged traded funds. If you look on your screen, you'll see I've already got some stuff written here. I've got the mutual funds over here, and I've got your ETFs, as they're generally referred to as. And then I've got, I'm going to first start with what they are, and then I'll talk about some other interesting information about the two. Well, first of all, what is a mutual fund? A mutual fund is an investment company will create these. What happens is you purchase this, and the investment company actively goes out and puts it together a pool is referred to as pool diversification, a portfolio of stocks, and then you are the owner of those shares from the mutual fund company. Now, the good thing about some of the advantages, and I'll just go and put the advantages here, is the fact is you're now diversified. Diversification is very important in finance. Second, you have the a professional manager managing your money. That is a good and a bad thing. And I'm going to get to a caveat about this. I'll put a little exclamation point so I can come back to that. And the third thing is they're just convenient. What I mean by convenient, if you were to invest yourself, you have to spend the time in doing the research, and if you have a full-time job, it's kind of hard to do that. Therefore, the mutual fund investor or professional manager does that for you. Now, what I'm going to talk about here in a minute is I'm going to write it right here. It's called the Vanguard. Vanguard is one of the mutual fund investment companies. There's hundreds of them. Actually, there's over probably 24,000 different mutual funds. So they can get a little bit difficult to research, but I'm going to just go ahead and use one, Vanguard. And in a minute, I'm going to show you some information on Vanguard, how to find some information. Now, there are two types of mutual funds. Let's get a different color here. The first one is referred to as an open-ended mutual fund. And the second one, you guess, is a close-ended mutual fund. Now, the close-ended, or the open-ended mutual fund, is typically what we refer to as mutual funds. Mutual funds, a little F there, mutual funds. There's an L there. Pretty much you have unlimited number of shares. We create shares. And basically how these things work is we may go out, when I say we, the professional managers, and they may say, I'm going to create a mutual fund that looks at a sector. So I can create a mutual fund, maybe in energy or healthcare, or maybe I can do some research and find some growth companies and put together a mutual fund of growth companies. Or maybe I can say I want to get a mutual fund with bonds, or maybe even the combination of bonds and some stocks. It's kind of unlimited here. It's a lot of choice here, and this is where it gets difficult for your average investor. Now, another thing that, the difference between the open and closed is a closed does not have that unlimited. It has a fixed number of shares. Fixed number of shares. And you can trade them just like stocks during the trading period, during the day trading period. You can trade these close-ended shares. Now, another thing you have to, it's important to know about a mutual fund is something referred to as a NAV. I'm going to pull down here and I'm going to talk a little bit about a NAV. The NAV, or net asset value, is very analogous to a stock's market capitalization, or what the company is worth. So if you know what the company is worth, this is what the entire pool of diversified holdings is worth. And to find out what each share would cost for the mutual fund, we just divided it by the number of shares that were outstanding. We got the share price. We do the same thing for the NAV. We just take the number of shares of the mutual fund, and we can find this individual NAV price. Now, a moment ago I had this little caveat. I'm going to come back to caveat now, because mutual funds will cost you some fees. So I'm going to go ahead and stop right here. I'm going to put the fees. Put number one. The first fee is sometimes referred to as a load fee. Now, a load fee is an amount of money you might have to pay to get into the mutual fund. Generally, load fees, well, I was going to say something to the effect that a load fee is because you think the mutual fund is going to outperform other ones. There are a lot of good no load fees as well. I'm partial to no load fees. I can find some good no load over load, but that's just my individual take. These loads can be on the back end. So A second fee is something referred to as the 12B-1 fee. This came out, I think, in the early 80s. It was more for promotion and selling, because these do have selling expenses, because these are something we have to market and sell to clients, whether they're organizations within their mutual funds or individuals. And the third is those fees right here, these the expense to manage this portfolio. Which brings up a point I wanted to mention here. If you know that the mutual fund that you have is changing managers, it's kind of I say when they change managers, I put a red flag here, because I don't know if the new manager can manage these as well as the older manager. So it's good to watch that mutual fund to make sure it still performs the same way. Now I'm going to pull this screen down. We're going to come over here to the ETFs. What is an ETF? Well, an ETF works this way. Here's your investor, just like an investor here, and you can see these are relatively new compared to the mutual fund. An ETF is created by a sponsor and placed in a trust. Once it's placed in the trust, the investor then, let's get it green. Let's go back and get it green, because we're putting money, can now purchase this trust. Generally, they refer to it as a, error this way, something called a creation unit. Generally, sometimes they call it creation unit. And the creation unit, let's say we put this ETF of 50,000 shares. Remember, they're fixed here, because an ETF operates like the open-ended, but it trades like the closed-ended mutual fund. So it operates like this, but it trades like the closed-end. They're fixed. So you can buy one share. Now you own 1/50,000th of this particular ETF. Now the neat thing about an ETF is that it's an index. You can't beat the market, but the market can't beat you. So one interesting one is this SPDR, SPDR 500, and that mimics the S&P 500. So if you are a person that does not believe that this active manager has the ability to do that, and there are some that believe they can, and some people believe some of them can outperform the market, you can just invest in an ETF, and it has much lower fees than the mutual fund, because it's not really actively managed like it was over here. Also, I mentioned earlier, I want to put a line here, 401ks and 403bs usually are comprised of different mutual funds. So if you get a job and you have that ability to put that money in that 401k or 403, the biggest decision you have to make is your allocation. When I say your allocation, the money of different mutual funds, because you're going to have the choice of maybe 10, 20 mutual funds, and you don't want to put all your money into one, although there are some that are designed to mimic person's age, because as we see, as the age rises, we tend to get a little less risky. We put money from the stock market into the bond market. One rule of thumb was always take your age, subtract it from 100, and that's the percentage of bonds or stocks. So if you're 40 from 100 is 60, so 60% of all your money should be in different types of stock funds, and the other 40%, well, technically not 40% bonds, but a portion of that should be in money market, which is short-term holdings. This is the diversification. This is the hard part about the 401k, is to try to figure out which mutual funds you want to put in and how you want to allocate it. This is what's important for the employer to help you out here. That's the priority. Now, I want to go ahead and show a few things on a mutual fund. And I'm on Yahoo Finance. You can go many different places. And if you look beyond Yahoo Finance, I'm under market data here. And I go under market data, you can see I can click on ETFs, and I can click on mutual funds and find a lot of information. But I went ahead and pulled one up here. Here's your Vanguard 500, one of the more popular ones. And I'm going to go to it. So now I can see its NAV prices right here, and that's how much the entire thing is worth, $176 billion. And if I divide by the number of shares, this is how much it cost me per share. And it gives me my year-to-date return. But I tell you, a neat part about Yahoo Finance, and you can get these other places, you find what you like. I like these sections right down here. Under profile, I can come in, I can find the fees. So if I pull down here, I can see just some information here, but I like the fund summary, and I have all my fees right here. And you can see that is only 17 basis points. So if 1% is a $1, that's 17 cents. That's less than 1/5%. So it's a very low expense. So most of your money then goes to capital gains. You don't have to pay a lot to manage it. And it doesn't take a lot of minimal investment to get started on this particular one as well. So that's a good one. I also like under this is I can go to their holdings and performance. So I'm going to go to holdings really quick, and I can see what investments they have. These are some of the investments and the net assets they have in it and the return. So you can also, if you're looking up companies, reverse this, go to from a company and see what major holders of mutual funds hold that particular stock. So if you're starting from a company and you want to see a mutual fund holding that company, you can do that as well. So I hope this helps a little bit understand what is a mutual fund and what is an exchange traded fund.